Anyway, let's get on with this thing. Access to the webinar for educational and informational purposes only. Consult a licensed broker, registered investment advisor before placing any trades. All securities and orders are discussed, contracted, monitored, and virtual trading accounts, virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates or any of their respective officers, personnel, representatives, agents, or independent contractors in such capacities. Licensed financial advisors, registered investment advisors, registered broker dealers. Nothing contained in the webinar or website or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Okay. Trading options involve risks. Visit the OCC website, www.optionscoding.com, to read the characteristics and risks of standardized options. PSW provides education and training services meant to teach the risks and potential rewards of trading options. We have not service sales warrants trade. We are not applying guaranteeing any profits. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results. Results discussed in this webinar are not typical and are valid only on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mail list to receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone. Haha. See, I can do that. Not that hard. Frickin' Watson. All right, guys, what is happening in the world? Let's find out. Gold, nothing. Gold is doing nothing. Oh, I must buy gold. That's cheap. All right. This is a long-term chart. Hang on, let me make the question small for a minute. Why is this? It's not that long-term. Okay, because last week we talked about buying gold. What is today? 20? I don't know what last week was. 18th, I guess. Last week we liked gold here during the webinar, and it's been up and down since. And it's still in a pretty good place. I still like it. Let's see if silver's better. No, they're both up from where we picked them up. So last week was the 18th. We liked silver at the line here, and it went up and now it went down, and then it went up and now it's down. You know, it's kind of risky here. I'm not as in love with silver as I am with gold at this spot. Either one, though, hopefully they're going to break up, but if they don't break up, it's dangerous. So maybe not, maybe no play there. Copper, China just said supportive things about copper and popped it up a little bit, but not really holding it too well. Now, of course, China's got to say nice things about copper because copper is used as a collateral for many, many, many companies in China. So if copper prices are down, then banks are short on collateral for their loans, and it causes all kinds of problems. So we got to watch out for that. Anywho, indexes, or indices, as it says here. NASDAQ back at the highs, S&P back at the highs, Dow lagging, Russell super lagging. Nikkei down there, Eurostoxx finishing. They had a big pump at the close there, right? They really recovered right at the last second there. DAX too got a big punch up at the close, but still finishing down almost 1%. So nothing exciting there. Now, for the Russell, let's say 17. I would really call it 1707.50 because it's right in between. So 0750 down to 80 is 2750, and then figure 5-point bounces. So 85 is a weak bounce on the Russell. 90 is a strong bounce. So the Russell's not really recovering until it hits 90. This is just a weak bounce, and if it fails here, it's actually a bad sign. But the other indexes are all obviously giving bullish signs. They're recovering fully. The Dow, if we were going to calculate the bounce on the Dow, it's from 25,250. That's 25.1, so 150 points, and they cleared it easily because 150 times 20% is 30 points. So that means 60 was a strong bounce on the Dow, so they're well over that. So you want to see if the Dow holds 60, and you want to see the Russell get back over 90 to confirm a bullish move. That's where we are there. Energy, I forgot about oil. I'm shorting oil. We already shorted oil earlier, made some money, but now I shorted it again because I'm greedy. Where's that? Hopefully we get some future trades off today. Oh, look at that. That's a good one to short. We don't have a reason though. We have to do the news so we see if we have a reason to short things. Remember I said I wanted to short again 25.2 and we didn't quite make it, so it's a little annoying, but I think we can use that line as a proxy, 28.30. None of these are still set up the way really that I like it, but we'll deal with what we got. Okay, so 28, really, I'd rather be higher, but you can't always get everyone. 75, also a great line for shorting on NQ. So there's lots of good lines for shorting we had already. What I've been playing with is oil. And so I have 4 new shorts now, 69.40 average. I think that's the correct average actually. Let's see, my average is 69.40 and I'm down 300 on 4. That's about right, yeah. So that makes sense. Earlier, I made obviously more than 1,000. I'm down 250 on this set. So we made about 1,400 bucks earlier. And I just blew some of it playing with this, so we'll see what happens. Let's see, do we need this thing? I gotta get this set up properly because it's a real mess. It's my new computer safety. Well, the problem is I only use it once a week for the webinar, so I never really think about updating it or doing anything. It's my travel computer and webinar computer. But anyway, let's see if anyone has any questions to start us off, and we'll get back to the agenda. Do you like gasoline short? Is the question from Brendan. So let's see what we think about gasoline. That's going to be RB. And, you know, look, not so much because gasoline, you have the holiday coming up at the end of August. And that's the last hurrah for the driving season for the summer. So I'm not so sure about gasoline short. Oil, I think, oh, it's 1 o'clock. We can look at the report. Oil, I think, is way overdone at 68.50. I'm at 69.50 now. But gasoline is not so terrible. 212 isn't bad. I mean, I think $2 should certainly hold up. So remember, there's serious reason to short gasoline. But let's take a look at the report and see what the report says. Initiate webinar. Text to speech. I'll get that one day. So it's the petroleum status report. Thank you, Google. You know, I gotta say, there's nothing wrong. Well, there's a lot of wrong. There's nothing really wrong with a monopoly like Google, as long as they're nice. But in fact, because they have a monopoly, they can do really cool stuff and make themselves useful because they really do control pretty much everything. And they use the groupthink of all the people who put in the word petroleum and say, you probably want the petroleum status report. You know, just based on a couple of keys. That's really freaking convenient and very productive and everything else. And then when you try to like restrict them like Europe is doing, you kind of ruin a lot of the good features that they have. But obviously the ability to use that stuff for evil purposes makes it very scary that they do have these kind of monopolies and have this sort of power. You know, when you think about it, if Google buries something, it doesn't exist pretty much. Because 90% of the people on the planet are using Google to look stuff up. So if you're looking for stuff and Google decides not to show you something, it doesn't matter what it is. You just aren't going to see it. You know, it's unless you specifically are going to that thing for some reason and you force it in. And how often do you ever do that? And that's crazy power. That's like, you know, I mean, they can direct the thoughts of billions of people. That is insane. And we're letting them do it. And, you know, and again, it goes back to, it's like, well, hopefully they're nice guys. But, you know, I mean, even nice guys can get corrupted or be taken over or be subverted or so on and so forth. You know, I think step one is that we need to really We need to bring back philosophy in school because we have a lot of moral quandaries we need to answer. You know, philosophy was very popular during the Industrial Revolution because the rise of machines, not that we even think of those things as machines really anymore, but the rise of machines that would do the work of the workers and were replacing people, and the changing status and the social mobility and so on and so forth. All that stuff breeds a lot of questions that it's hard to have a good answer for. And people need to think about this stuff day and night. The problem is we don't have philosophy, and the people who make these moral decisions are freaking computer programmers with no life experience. It's really scary. And it probably won't end well if we like keep this up. You know, we need to breed philosophers. And it's not that hard. You can do it in 10 years, because realistically, high school kids don't, you know, I mean, when you go into junior high school, you don't have a philosophy background. That's something you start developing maybe in high school when you have some teachers start teaching it, and then in college, people go and major in philosophy. So you need an 8-year program starting right now that puts thousands and thousands of kids, as if it's a national emergency, through philosophy studies. And we need to incentivize the best and brightest kids to get into this thing, because we need people who sit down and think about this shit. Because we got a lot of moral quandaries, but then of course you have to, just because they think about it doesn't mean anyone's going to listen. So we need a whole program to sort of like think about what the hell we're doing with, you know, robots and welfare and unemployment and debt, and whose responsibility these debts are, and so on and so forth. There's a lot of questions we need to start thinking about. And nobody's doing it. Nobody who's qualified, I'm sorry, everybody's thinking about it. Nobody who's qualified to think morally is doing it. And that's the problem. And I'm no expert. I've taken philosophy, but I'm no expert in philosophy. But, you know I have respect for the people who did study it and really were experts and really looked at things from like a huge perspective of humanity and thought about the implications of things and sat there pondering. We don't pay people to ponder, and we need to, because we're just like we're just barreling into crap, and we are changing the world in incredible ways that may or may not be good, probably not good. I mean, people are dying in Japan of heat. It's messed up. You know, I mean, there's, I mean, obviously, everything can't be reduced to an economic argument. Anyway, back to the petroleum status report. Getting off topic. So here's the 1 o'clock report. Now you have to make sure July 13th, and this is not the right report. See, they do this a lot. They're really lackadaisical with this thing these days. This is not the correct report. This is the old July 13th report. Maybe if I refresh it, I don't know. Nope, they simply haven't bothered publishing the new report yet. Crude oil inventories increased. No, that was see. And by the way, that's the funny thing. Last week, inventories increased by 5.8 million barrels, and today they're down like 5.8 million barrels. Gasoline was down 3.2, and distillates were down by a little bit. So last week was a net build of 2.6 minus 4 is 2.2 million barrels build last week. And what happened to oil last week? Got to always be in perspective, you know? So last week, on, was it the 18th? Yes. So last week was the 18th, and we had this, we were down to 67, and there was a tiny, tiny build, and they popped it up and whatever, and then it came back down, and now we're back to here, which is right about up here. On a better, I would argue, certainly a better inventory report, but not so great, because it only offsets, it only breaks even with last week's build. So we went up for no reason last week, and now we can't go up for no reason again. That doesn't make any sense. So that's why I was pretty comfortable shorting. And we'll see what happens, though. It's a lot of moving things. And this whole, you know, the sanctions with Iran and Trump threatening back and forth, it makes it very hard to short oil in a serious way. All right, so back to work. Where did my comments go? You guys don't know. You can't see them. So, okay. Hang on. Nope, I lost them. I hope they're back here. Questions. Yes, there they are. We're going to pull that out and see what happens. All right. So, oh, I'm sorry. So we can't answer the question of the RBOB short because we don't know what the freaking petroleum status report is right now. We don't have a real one. Let's see, if I go back to here, what if I refresh this page? Oh wait, what are they saying here? We will begin reporting crude production estimates rounded to the nearest 100,000 barrels. Okay, well that doesn't matter. Click it again, and it's still July 13th. No, they're just simply not going to bother doing it. All right, so let's see. Three says, Phil, have 20 Enbridge October 18 calls at 44. Currently 140. Please advise. Was hoping would cross 40. Wait a minute. Well, I certainly did make a play to have naked calls on Enbridge. Whoops. So October. So you have 20 October 35 calls. I see. Here we go. So you have 20 Enbridge October 35 calls. You bought them at 44. They're now at $1.40. So they're up 200% or more than 200%. They're up 250%. And you're hoping that they go up thousands of percent. Is that the gist of the question? So Brendan says at 212. Are you saying the petroleum status will be out at 212 or are you saying something else? Oh no, do I like RBOB short at 212? Okay, that's the other question. So no to RBOB and until, especially until we check the report. As for your ENBs, let's find a chart and see what they even look like. ENB. Wow, 40. That seems like really. I don't know. Why would they go back? What's the premise? And anyway, when I'm up 250% on a trade, I generally don't. You have to convince me not to take it off the table. I'm not going to certainly say don't. What's my advice? My advice is take money and run. You've got a profit of $2,000 on a trade that you spent $800 for. So I'm not sure why. You have the stock at 38, bought options to average around. Okay, so fine. So now you made $2,000 and your stock has dropped from 38 to probably where it is now. So again, all right, look. So Enbridge is 35. You have a stock at 38. Let's assume that you have 2,000 shares and you bought 20 contracts, which is not the same as doubling down. It's adding to risk, but besides that point. So what you've done then is you've now, since you've made $1, on these, you've dropped your basis from 20. If you cash out, you've dropped from 38 to 37. Then yeah, I'm just saying though. I mean, as far as playing a little more conservatively. So if you're at 37 now, you can then turn around and sell 20, 35 calls for $3, and that would drop your basis from 37 down to 34, but with a call away at 35. You probably don't want to do that. You seem to be more bullish. But I mean, I would certainly keep a tight stop on this. I wouldn't be putting all your marbles in the thing going up and up and not pulling back. You made some money. You gained some of what you lost back. So, you got to learn to take profits. It's kind of important. If you don't take profits, then you won't make any profits. I think that's kind of obvious, right? So, and they're only October. All right, hang on a second. All right. So they just got back over the 200. They got their approval. I don't honestly know the numbers on these guys. Let's take a look and see what they look like and how much the pipeline is going to affect them and so on and so forth. So look, they got a high PE. It's there right here, 33 times earnings. They're already trading at a pretty high PE. They pay a huge dividend, but you don't own. Well, you do own the stocks. So that's good. You're gonna collect your dividends. Financials say 44 billion in sales, 3.2 billion in profit, and you can buy the whole company for 60 billion. So P is 20. I don't know what these guys are talking about. Analysis says they're going to make $1.50. Oh well, $1.30 something. Next year they'll make $1.60. Let's say that's not good. It's still, but you still be going back to like a 20 PE. So the PE is actually better than what Yahoo says. I'm not sure where they get that number, frankly. I don't know how much revenue that pipeline is going to bring in. That's the question. You have to, if you're going to invest in a company like this, and that's your premise, then you should be able to tell me what percentage of their total business is a pipeline going to be for them. That's my question. The L3 pipeline means what? Means how many gallons? How many? What do they charge for it? What do they expect to get for it? How much is it going to add to their revenues? I'm sure they did a presentation somewhere that said these things. That's what you should know if you're going to be investing in this thing. Because and then you want to pay attention to the fact, like, does it really do what they said it would do? Would it really put that much through? Is it going to be full to capacity? Or are the sands possibly not producing as much as they used to? All that stuff matters. Not only that, but when they build a pipeline like that, costs, whatever, let's say it costs $2 billion to build it. Now, they anticipate revenues of, let's say, $200 million a year for profits, not revenues. They anticipate profit of $200 million a year for 20 years. So they're going to make twice as much money as they put in. Over the course of 20 years, they'll make $2 billion. And I'm just making up numbers. So then you have to say, well, is that baked into their plan already? Is that already part of the numbers and part of the anticipated profit and so on and so forth? Or is it such a massive addition and it's not even 10% to their bottom line? So then you have to, once it's operating, you want to see that they're actually moving and producing the 200 million in profits every year. It has to be actually running at that rate. Otherwise, what's the whole thing about? So, when there's a very valid reason to invest in things like that, but you came in at 38, which means they haven't been at 38. So you came in here, yet when they were at 28, you didn't buy any more. And apparently only recently, probably here, which was a good move, but finally, when they finally started going up, you added some calls. And adding the calls at 44 didn't seem very, you know, I mean, it wasn't a big risk. It was a good way to leverage your position a little bit more than you had. But, you know, the better move, of course, would have been to say that you had a good reason here. When you came in here with a reason. If your reason was still valid here, then that's the time to add. You know, when you have a more than 20% drop in the price, let's see, $48 drop. Yeah, that's right about right. So you had a 20% drop here. That's the time to say, oh, I want to add some more, because then my cost average will be down 10%. And had you done that, if you came in at 30, I forgot what the number is. You said 38. So if you came in at 38 and then you bought more at 28, then you would have been averaged down to 33. I mean, you could get half. You could have been half out by now, even, and then you'd be in amazing shape. So, you know, just, you know, keep that in mind next time. It's like, don't go so in that you can't afford to adjust. I mean, that really is literally the entire key to success in the long-term portfolio, is that we do not take large entries. We go with a small position, like what we just did today. It's almost embarrassingly small. We just did, oh, that's not this week. Hang on. We just now, before the webinar started, we did, where are you? Here you go. So we were discussing fiat. This is how it goes in chat, okay? Because here, Control F C A U. So Advil said at 12:20, is fiat an opportunity? I think we've been talking about cars before. And oh yeah, here's what happened. So we've been talking about Ford and GM and everybody being down. And I said here, and I put up the charts of Ford, GM, and Fiat. And here the CEO died. They got really slammed because their CEO died last night, and everybody's kind of worried. But you know, while yes, he was a good CEO and people liked him and so on and so forth, and it's disruptive when the CEO dies, it's not the end of the world. It's like these big, huge companies. You got $100 billion in sales, and whether or not one guy is a CEO really doesn't make or break a well-run company. You know, it's like it's disruptive, it sucks, and there's problems, and they may miss a step or two, but as a long-term investment, you gotta pick it up. I mean, you really think that a quality person isn't going to want to take over at Fiat Chrysler, and the board is going to do a hunt for another CEO, or they'll fill it internally, or whatever they do? But the point is that they're going to get a good guy in the place. You know, one reason Macron was so great, though, is he wasn't a corporate guy. He was really a car guy. And he came up through the ranks as a car guy, and he was all about quality cars and making cars and so on and so forth. So he did a lot of good for that company, and hopefully they'll see the need to just put another person like that in there, not get some professional CEO. Oh, how about Elon Musk? You want to bankrupt Fiat? Wouldn't that be funny? Oh my God. It'd be tragic. Anyway, all right. So we get in this conversation. Is Fiat an opportunity? The CEO dying doesn't help. Let me say here, and then I say, well, when they get a new CEO, they'll probably pop. But this tariff thing has to play out. Overall, I live in long term with this price. And whatever they say, went in for shoulder surgery. So then I'm sitting there, I'm looking at the numbers, so I'm sharing it with everybody. I'm saying, you know what? There's not much sales growth, and here's what I mean. Like, look, 110, 111, 110, 110. That is not exciting. Now, they're projecting 115, 117, but I'm sure they projected 115 and 117 here too. I mean, you always project that you're going to get, nobody goes out and projects flatness, you know? It's like, it's not like a thing when you're doing your earnings. You know, we decided, so I decided, I said, look, we have this long-term portfolio, it's filled with cash. It's silly not to sell 10, 20, 2017 puts. Why? Because it's not even $500,000 portfolio anymore, because now we're like at 650,000. But it was a $500,000 portfolio. Our allocation blocks are $50,000 each, and with buying power of $100,000. And here we're spending at most, if we're selling 17 puts, all that can happen is we get assigned 1,000 shares at $17,000. That's nothing. That's a very small thing, right? So that's what I mean when I say it seems silly. It's like we have these empty allocation blocks. We have plenty of money to use. It's sitting on the sidelines. So here, this trade has a worst case of us owning 1,000 shares of fiat for this. Assuming we get wiped out, we would lose $1,600 that we're spending net, and we would lose, and then we'd be assigned 17,000. So we'd end up losing, it'd be 18,600. So our net entry would be $18.60 per share, which is $1 more than it is right now. That is the worst thing that can happen to us. That's not such a bad thing, because even at that price, we can easily buy 2 more. We could double down twice, and we still would be barely filling an allocation block. So there's almost no downside to this trade other than owning a stock that we like anyway. Which means there's no reason not to do it. That's what I mean when I say it's silly not to sell them. It's like, why would we not do this? There's no downside. So all we're doing is potentially filling an allocation block, but we haven't even started yet. We sell the puts. We pick up a spread. And again, because we don't need this money, this $3,000 is meaningless selling the puts, and gaining $3,000 isn't much, but I'd rather do it this way than sell 20 puts for $6,000, because then I'm less flexible. By only selling 10 puts, we're very flexible because we can roll this down to 20 of the 2021 15 puts or the 14 puts or whatever. We can do a double down roll and still be at an incredibly low, still be at a half an allocation block. Because imagine that here. FCAU. So imagine that currently, hang on, I gotta hide the question thing. All right. Oh no, that doesn't even help. All right. August, there you go. So the 17 puts, so imagine we get to January 2020 and we're at 1650 and the 17 puts are 90 cents, okay? Fine. So then what happens? Then we're gonna roll to the 2022, the 13 puts are now more than 90 cents. So we're gonna be able to roll $4 lower over the next 2 years. And then 2 years after that, another $4 lower. So do we realistically believe that fiat is going to drop another 50% in the next 4 years? And if not, then essentially that's free money for us, right? There's like almost no doubt that we're going to be in good shape. We don't forecast a massive, horrible recession or anything like that. So it's very safe to sell these. We're generating some cash. Not these, I'm sorry, we're selling the 2020s for $3. So it's very safe to sell these for that logic, because it a year and a half from now, when these things are the front month contract, they'll be here, or whatever they are. It doesn't really matter though. If they were the 21s for 450, then the 20s, that's not very good. You want to roll it before it gets too far on the money. If they were the 18s that were $1.70, those can roll down to the 15s, so $3 roll there. The 19s at $2.50 can roll down to the 17s for $2. So it depends when you catch it. But that's not even a 2x roll. That's a straight roll. A 2x roll, we could roll if we sold 10 of these for $3,400, $3,500, right? We could roll those to 20 of these at the 15s. So the 20s could roll down $5 to the 15s and be 2x, and we'd still only be obligated to own $30,000 worth. Not like basically half an allocation block. Our worst case in a terrible sell-off where we're 20-something% below the money, it still isn't that bad. And when you look ahead like that and you think of like bad things happening and it still isn't that bad, you're like, well, then why would I not get into this trade here? That's what you got to do when you're analyzing these things. You got to think about it from that perspective. It's like there's no good reason not to do this trade. So since making 3,000 isn't a big deal in long-term portfolio, and again, we don't want to get clogged up with positions that aren't going to make much money. There's nothing wrong with making $3,000, but now that the long-term portfolio is getting bigger, we have to think bigger in our position. So we have to start saying, you know what, making $3,000 just doesn't do it for us anymore. Otherwise, because we're at $650,000, we want to make $200,000 next year. And if I'm only going to make $3,000, that means I'm going to need like 60 positions like that to make my nut. And I don't want to have 60 positions like that. So I got to make more money per position. So we're going to add the bull call spread, and we're adding 20 of the bull call spread. So instead of collecting 3,000, we're spending 4,600 on the spreads for a net 1,600 out of pocket. But now, at just $20, okay, and we're at $1,650 now. At $20, we're going to make $14,000. We're not going to get 14,000 back. We're going to get I'm sorry, yeah, it is. We're going to get 14,000 back for $12,400 profit. Now remember, I want to make $200,000 next year. So I only need 20 trades like that, and I'm in good shape. And that's a lot better. I don't want to have 60 open positions making 3,000 each. I want 20 positions I can manage that are going to make me $10,000 each. So when I look for new positions, I'm saying to myself, I want to make sure. Now, sometimes we'll sell a put just to sell a put to keep an eye on something. We have lots of those in the long-term portfolio. But this isn't one of them because the puts are cheap, and there's only two ways to go. We're either going to sell a lot of puts, which puts us into an obligation that we may not want if it starts going down, or we keep the put amount small that we can happily double down on and add an upside spread. Now, if fiat goes down 20% more, what are we going to do? We're going to roll these down to a lower strike or out to 2021 and give ourselves some more time. And we're going to roll the puts or double down or whatever on the puts. And then we'll have the position for a longer term at a cheaper price. That's also, again, not a bad downside. But it's easy to have a trading plan, and it's easy to be flexible if you follow the scaling in strategy. And the scaling in strategy, I know it's people will go, huh, what? There, we have a strategy section on Phil Stockworld. In the strategy section, we talk about the first thing I talk about, see the article on scaling in. I do not generally enter a position when momentum is taking the wrong direction, or if the market is moving in the wrong direction. I rarely take a full position right away. See that? Rarely take a position right away. Generally, out of the list I share with you, I look for ones that have been going the wrong way. And then after I check the news and other factors to make sure my assumptions aren't wrong, we see if there's an opportunity to jump in as a contrarian once the wrong way momentum seems to be slowing. Getting options cheaper than I originally planned. Well, what does that mean? So first of all, there's an article on scaling in, talks about the whole strategy there. Then we go to virtual portfolios, and hopefully we can find BUY. No, not a buy list, sorry, it's a watch list, not a buy list because we're not buying it. Watch list, stocks we like for 2018. Oh my God, seems like it's as if he wrote down all it's like as if the guy wrote down exactly what he was going to do for the year. It's amazing, right? 24 stocks that we're keeping a close eye on for 2018. Apple, which we took, of course. ABX we took, not doing so good, but still an opportunity. That's what the buy list is about, right? The watch list, sorry, watch list. It's only a buy list when the market crashes, and it's a buy list. Then we make a new list of things we definitely want to buy. Alaskan Airline, we got some of that. Best Buy, we got some of that. BX, I don't know if we got it or not. Oh, we did. We sold some in the long-term portfolio. Cake, we bought that shot up. CBI, CBI merged, and then we cashed out on that. That was a good one. CDE, we have some of that. It's been flat, but flat's fine for us. We make good money on flat. CHK, we ended up buying. It went flying higher. CIM, we did not pull the trigger on, unfortunately. Okay, it's a REIT, blah, blah, blah. I love CIM. It's one of my favorites. I wrote this, I wrote that back in 11. See, in 11, I said I'd like it. We really should have picked it up in February. I was just not paying attention because it dropped nicely. CLF we went into, they've taken off. ETT. So again, keep in mind, I wrote this on January 3rd. These are all stocks that we said we would like to buy if they got cheaper. So when they get cheaper, you buy them. It's not complicated. Ford, when it gets cheaper, we buy them. FNSR, they've had a rough time, but they're finally catching a little bit of a support here. So we like them. We already have them. FTR, we have, of course, they've been in the crapper. GCI, we did not pull the trigger on. They're back to a pretty cheap number. 10 is a good number for them. GE, we like them. They don't like, nobody else likes them. We like them. Gilead, we picked up some puts. You know, and again, same thing, right? Coming back. GNC, we have a position in GNC now. They're going nowhere fast. GoPro, we have a position in that one. I think we cashed it though. But they're struggling along. But I mean, I think they're okay there. H&R Block took a dive. Great opportunity to add some. I think we did add some at that point. IMAX also, whenever they dive, we add some more. LB, still a great trade. Macy's took off, gone. Fortunately, had it. NLY, flat, but the good kind of flat for us. PSA, whoa, man, that's crazy. They really took off. SKT, I love. We did end up buying some of them. And when did we buy it? We bought it when it got cheaper. It got cheaper. I said, oh, let's get it. It's cheap. SunPower, you know, I look at this list all the time. I mean, I look at this like once every couple of months, I'll take a look at this list and see what I can buy. Whenever I don't have any ideas, I go back to the list. You know, if I don't see anything particularly cool that's good to buy, I just browse through the list and see who's cheap. SunPower is nice and cheap again. You can pick it up. Target took off. That's gone. THC, we fortunately bought this one. And by the way, January 3rd, that's when we started our new portfolio. So all these were like brand new, all the blues were brand new portfolio plays on January 3rd. This one was a monster. We cashed that in already. Wheaton's another one that's just, well, they had a crazy time. They went way down. We bought more, fortunately. We added more. Now it took off again. And here's Whirlpool, just in the crapper now. And we sold the 130 puts for 1120. So our net entry is, you know, one less than 120 is our net. So that was our worst case. As it just dropped right now, we didn't do anything with the puts because really we're right where we need to be on the puts. You know, obviously we'd like them to expire worthless, but there's no need to adjust or do anything. Better off waiting for 2021 to come out and see what we can roll into. Why should we add more, do more, anything else? When it really bottoms out, if we can sell more 130s or 2021 something else for a good price, we might do some more. But you know, look, 5 times 130 is a lot of money too. It's like $75,000. So $65,000. So it's a half allocation at that point. So we don't really want to overcommit to the put side. So we're just leaving that alone. But what we did do is we added the bull call spread because I think they're cheap enough down here. So that's the gist of what we do. I mean, we have a trading plan. You watch the stocks, and when they get cheaper, you buy them. It's not complicated, and that's it. I just went through our whole strategy was just laid out there. That's all we do, and everything else is just watching stuff and looking at stuff and talking about stuff. All right, back to questions. 3 is still talking about Enbridge, and he says it's a $9 billion replacement project. $9 billion, holy cow! That is currently struggling to ship volume. Uh-oh. Canada brought half the pipeline for $4.2 billion. Permits are impossible. Tax reform. They lost their double tax deduction. Did a major reorg buying out. Well, it doesn't sound that great, you know. I mean, you're not really selling it to me. So it sounds like it's messy, and they only get half the profits, which means they're going to have a much longer payback cycle. I don't think that's great. Oil gets dumped. Fantastic. Thank you. Let's see. Okay. Naomi says, thoughts on tea. Sold some tea puts that are now in the money. Should I take a loss? Probably not. Basis is 31.75, or get a sign. Something calls. You're not going to get a sign, most likely. It's very unlikely you're going to get a sign. But let's take a look at that in a minute. But hang on, because these guys are saying there goes oil. So I bet there was something in that report that wasn't good. Active trader. Oh, that's not that bad. All right, nice for me though. So you made a nice $1,000 since we've been talking. So I'm happy. And I didn't really want 4 short, so I'm gonna keep a very tight stop here, like 25. I'm gonna get out of 2. So hopefully no, it's not. All right. 1 and 2. Can you guys get a little bell sound when I do that? Did you hear that? I'm wondering what the extent of this thing, like, stopping you from hearing computer sounds is. Anyone? Bueller? Nah, see, I don't like that. I don't like that. That spiky tail is not good. Nah. I'm gonna take it out. Done. I mean, you make $18.50. It's like, take the money. Ah, you bastard! You won't give it to me. Now you see 40.20. I was just saying. See, when you see 40.20, it's got a very good chance of going higher, and so you should do your cash. You should cash it out. 40.40. Oh, 23.7. Now I'm gonna get the price I wanted. There you go. All right. So on the whole, up 18.60 for the day, and I've traded in and out of 10 contracts today, because that's what I do. I go in, I go out, it goes up, I do another one, it goes back down, I get even. It's just, you know, you're just scratching out a game, but that's fine. There's nothing wrong with scratching out a game. You don't have to make a ton of money in one shot. I traded 10 times, so my average gain on each contract was $200. But what I actually did is I got in at like 69 or something. I don't remember what my first entry was. My first entry was probably about 69. It went up, and I added right here at this red line. My basis is in like 69.11 or 15 or whatever it was. And when it got back to it, I cut back immediately. I then got this ride down. I cashed back out. Then it came back up, and I narrated what I was doing. I said, look, I get 69.50, and I went back in. That was my average from the time before. So at 69.15, I went back in. I ended up with 4 short up here. And then as you saw, I just cashed out 2, but then I didn't like the action. I didn't like the way this looked. And maybe you guys can't see it. Let me see. You see that? When you form a candle with a tail like that and a base that's up by the other base, it's probably done going down for the short term. So why should I ride that out when I have almost a $2,000 gain? Why should I ride out why should I ride out 10 cents against me? 10 cents against me is $100 per contract. So why would I give that up? I don't need to squeeze out a big profit on that thing. Okay, it's not necessary. Any profit is a good profit. And that, by the way, goes to the thing we were talking about earlier, where you made $1 on your 40-cent bet. Any profit is a good profit, and unless you are 100% certain that you're going to make more money, at least lighten up on it. Put a stop on the rest. You know what's interesting? If you stop out, like let's say you have $500 gain, right, on 4 contracts, and you stop out 2. And then those 2 go up to 1,000, right? What's your average gain going to be? Your average gain is going to be 750. So you're capturing 75% of the maximum gain, even though you took off half your winners. Taking off half your winners means you're going to still collect 75% of your maximum gain. But on the other hand, if it goes to 500 and I cash 2, and then it drops all the way back to 250 and I cash the other 2, now my average gain is 37.5% of the maximum. So I could have made 50%. I made 30, actually it's not 37.5% of the maximum. I made 37.5%. I only didn't make 13%. So you make 75% of all the winning, and you're only going to give up 20%. I'm sorry, and you're going to lock in 80%. You're going to lock. That's the best way to put it. You're going to lock in 80% of the gains by cashing out half when you have a good run. So why would you not do that? It's a bird in the hand being worth 2 in the bush, right? You're going to get some cash. You're going to be halved out. You won't have to worry about as much. If it pulls back, it's no big deal. So now again, I have no idea why oil's going up or down. So that's the problem. It's kind of hard to me. I'm just looking at the chart, but let's take a look. By now, hopefully this is updated. Nope, still. Wow. What's with these guys? Freaking government, right? Probably nobody works there anymore. Somebody said something Trump he didn't like, and that's it. The agency's gone. Anyway, all right. So thanks for saying oil just dumped, so I knew that. Otherwise, I wouldn't have taken that off. And again, you see my non-greedy exit so far is locked in a good gain. I'm done. I mean, I came out right about at the bottom. You know, I don't. That's another factor, by the way. Is I'm talking to you guys. I'm not going to be paying good attention, so I can't sit here and watch it tick by tick to maximize my profit. So I'm better off just taking some money off the table. But we'll do the news in a minute and see what's going on. So we're going to look at 18. So you guys could hear the bells. God damn it, that is so weird. It's the same freaking computer speaker making the same making noises. I don't understand. Anyway, I don't get it. It's frustrating. So where were we? Okay, so now I hope it goes back to 69.50 because then I'll be happy to short again. Even if it goes higher, I won't mind. News. No, wait. AT&T. What was that question on AT&T? Okay, she has some T puts. So Naomi has some T puts that are in the money. So T. Okay, I don't know what puts. You know, you're just saying some puts. Don't know how many puts. Don't know what kind of puts. But you're saying that your net is 31.75 and AT&T is at 30.26. So let's say that they're these puts, the 33s, which are like $1.70. So 33 minus $1.70 is 31.30. What? Wait, how's that possible? Oh no, the puts. Silly me. All right, so I'm sorry. You say you have some T puts. Should I take a loss? Basis 31.75. I can't figure out. Oh, I see, because your basis from what you sold it at. All right, so let's say you sold the 35 puts for $4, just to make it simpler, or for $3, $3.20. All right, for $3.25. So you don't have that kind of loss. Oh well. I don't know what you did, but let's say you sold the 35 puts for $3 and now they're $6. It doesn't matter what it is, okay? The bottom line is your net would be 32. So why would you pay this kind of premium and take a loss to get out of it? That makes no sense at all. Then you're just giving someone money for what? For no reason. Let them assign it to you. If they assign it to you, the premium goes away. Don't pay a premium to not get assigned. Okay, the worst thing that happens if you get assigned is you get assigned, and then you'll have what will happen is you'll have the AT&T in your account if you can't afford it fine, then you're going to have to sell it, but at least you're only going to lose 150 per. So if this contract is anything over $1.50 that you are short puts, why should you pay them more than $1.50? All they can do is assign it to you. The only threat they have to you is to assign it to you, and if they assign it to you, they wipe out the premium. So, I would not do anything with it. And if you're not in 2020 already, then wait and you can roll it. And if you are in 2020, if you're not in 2020, you can roll it to the 2020, put it to the lower strike. And if you are in 2020, then you just wait another couple of months and the 2021s will come out. You can roll those. But it's freaking AT&T. They're not going bankrupt. They're just out of favor at the moment. You know, it's an opportunity to buy more or to solidify your position. And if you don't want to do those things, then just wait for it to turn around. Because look, all right. Yeah, keep trying to have these. My answers lead to other questions. So sorry about that, but let's see. So if we go to the charty part, chart. T. That time for me. All right. So 5 years. Oh, wow, that's actually bad. All right. So here's AT&T since 2002. And it's pretty solid that this number 20, actually this is a great number. So 2162, you see that line going across the bottom. That's a pretty steady spot to hold. Now, obviously not very encouraging, considering, I'm sorry, let's drag this out more. My bad. All right. So since 2002, I'd say maybe here. So what does this say? About 25 bucks. So 25 bucks is really kind of low. It might go a little lower, but it's been years since it's been below that. Realistically, since the crash, you're looking at, you know, basically where we are now, down 28.50. Okay, is the low. It's got momentum to the downside. It might go down 28.50. So you have to decide what you really want to do at 28.50. Did you want to be an AT&T or did you not want to be an AT&T? If you started out with a 31 something basis and it's at 30 now, was that it? And again, it goes back to the allocation blocks. If you had only started with a quarter of an allocation block, you would be excited to double down now. You would be looking forward to buying more at 28. But if you jumped right in with a big number and it would be painful for you to actually own the stock, that's a problem. And you back yourself into a corner. But then what do? You wait until the 2021s come out and you look to see where you can roll it to. And you're either going to, at that point, you're either going to roll it or you're going to give it up. But, you know, it's freaking AT&T. It's not like they're going out of business or anything. And they're doing that Time Warner thing. That's what's killing them. They're not going down because they're a bad company. They're going down because they're buying Time Warner and not Time, whatever. Yeah, I'm sorry. They are doing the Time Warner deal, and people don't like it. People don't like. Nobody likes an acquisition when you do something so massive. So if you don't believe in that acquisition enough to ride it out, get out. But you should have gotten out a long time ago. And if you want to ride it out, then ride it out. But you can't be in a stock, and especially a massive dividend paying stock like this. They give away most of their profits in dividends. So they're never going to grow a lot. They're going to gyrate up and down in the channel because they keep handing out money and so on and so forth. Now, if the combined company starts cranking out money, they may steady up around 40. But, you know, we won't know that for ages. It's going to be quarters and quarters before we see what the combined company looks like and how it works and so on and so forth. But you can't be, you know, you can't play stocks like this for as if they're a day trade. It's a terrible way to get into them. You know, it's like you've got to have a long-term perspective. Otherwise, why are you taking these positions? Let's see.
3 says, Phil, any technique on hedging for results on something we already have a stock in? Say MCK cost 140, very nervous tomorrow. It doesn't work like that though, because unless it's like a massive, unless it's like a major component of one of the indexes where the whole index is going to move, how do you hedge a single stock? I mean, you can pick up options or something like that, but look how crazy that is, because what are you doing is you got MCK. And you know what your problem is you mess around with these expensive stocks, 133, that can go violently against you. And if you're nervous, you shouldn't be playing it. If any single stock makes you nervous, you shouldn't be playing it, okay? Like I go to the craps table, right? And again, allocations. I got $1,000 I'm going to play gamble with for the weekend. I go to a craps table and I cash $200 out of my $1,000 for the weekend that I'm perfectly willing to lose and will not in any way, shape, or form impact my life, by the way. Otherwise, I'm a problem gambler. But I go, and again, it doesn't mean I'm not angry if I lose $1,000. I am very pissed off I lose $1,000. I could have gone to Oyan and had a nice meal. So I could have taken 3 people out to Oyan and had a good meal for $1,000. So that's the amount of impact it has on my life. Like I'm gonna not do something fun that I would have done with $1,000. It's not like it's gonna stop me from paying my car payment or something like that. That would be insane. But even then, on $1,000 that I'm willing to lose, I'm only going to take $200 at any one turn sitting at the craps table. And of that $200, I'm then going to divide that by 10, so I have at least 10 rolls to play. And I'm going to spread $20 around on the table and see what happens. So on any single roll of the dice, which is what earnings is, I'm risking nothing. And again, it's not like I don't care if it wins or loses. I'd like it to win, but if it doesn't win, I'm just going to go, and I'm going to move on to the next one. That's what an earnings report should be to you. We've had several go against us this week, and that's what we're doing. We're like, and sometimes we go, wow, let's double down on that. Let's get some more. It's cheap. If you can't react like that when you get bad news, you shouldn't be in the stock. And the problem is if you don't have a very, very, very large portfolio and you're messing around with $100 stocks where every single contract is $10,000 worth of stock leverage that you're making, that's a lot of money. And if it's not a steady stock, like Apple, I don't mind having contracts on in a small portfolio because I have a rock steady faith in Apple going up, and even if they don't go up, at least they're not going to fall too far out of their range. You know, like Apple's what, like 140 now? What are they at? No, they're higher. Apple 200, silly me. Okay, so Apple's at 200. But the thing is, Apple's not going to go below 160. So I don't mind having plays on Apple that if Apple drops down to 160, 10%, 20%, I'm okay. Any stock can move 20% on you, and if you're not okay with the 20% move in the stock against you, don't get in the stock in the first place. We have no idea what earnings are going to be like for these guys. Not a clue. Could go either way. Could easily go 10%, 20% up or down tomorrow. So if you're nervous, get out. Don't try to hedge it. You're deluding yourself. And the cost of hedging it is too much money. Okay, because whatever you have MCK at one, and you're in it for 140, which is sad, and you're hoping it goes up, but if it doesn't, then what are you going to do? So here's 140. So if you're in it for 140 and you don't want it to go down, then here's something you can do. You can buy these puts, the 140 puts, for $8. So what does that mean? That means in the worst case, you're spending $8, but you're guaranteeing that you can force someone to buy your stock for 140. So if your stock goes down, you can't lose, other than the fact that you spent $8 to not lose. The problem with that technique, I don't want to call it technique, it's not really a technique. The problem with doing that is, yeah, and by the way, this is how I do it. I wouldn't take an out of the money put, because first it has to drop for you to make any money, whatever. This way, you're going to get most of your money back because you're guaranteeing yourself you're going to get 140 for your 133 stock. So even though it costs you $8 to pay for the contract, you're gaining $7 from where you are now. You're locking that in. So your worst case is you're only spending $1 to make sure it doesn't go lower. Problem is, though, of course, if it goes up to 140, then your contract expires worthless, and you're down $1 on a move back to 140. So you've wiped out your gain on the earnings. Now, the real problem with that is, aside from that, you're wiping out your gains because you're nervous. The real problem is that if you do end up spending, let's say you spend five, let's say you spend net 5 on the 135 puts or something like that. But let's say you spend a few dollars every quarter. Then you're giving up $10 over the course of the year, $12 over the course of the year. You've given up 10% of the stock's price. What the hell kind of trading is that, where you sit there and handicap yourself 10% of the stock's price because you're nervous with the stock? Don't be in stocks you're nervous about. Don't bet against yourself. So it's you say, sorry, I have a dividend stock from before I became a member. Then don't have it. You know how you make sure? Here's what you do. If I have 1,000 shares, we can't, 100 wouldn't make any sense. If I have 1,000 shares of MCK, okay, and I bought it for 140, and now it's at 133, I'm like, frick. Now earnings are coming up. I don't know which way earnings are going to go, but here's what I do know. I can cash the stock for $133,000. I can sell 5 of the 120 puts for $11. So that's $5,500 back in my pocket. And now what's the worst thing that can happen to me? Now the worst thing that can happen is I can end up owning the stock again for 120 instead of the 133 I just sold it for. That's my worst case, is owning it for 120. So you saved yourself from a 10% dip, a 10% correction. Also, you put 5,000 back in your pocket. So basically, of the drop from 140, you're back to 138. So you've taken away most of your loss by getting 5,000 back in your pocket. So you're not worried about earnings. You've got 5,000. You've got 133 plus 5, so 138,000 out of your original 140 back in your pocket. And the only bad thing that can happen to you is the stock drops severely, and you have to take 120,000 back and put it into this. But you know what? Then you're 18,000 better off than you were before. So how do you hedge your stock when you're worried about earnings? Get out of the freaking stock. And why 5 when you have 10 now? You have 1,000 now. Why go to 5? Because you know what? If it does drop 20%, and it's down at 26 minus 130 is 110 minus 107 or whatever it is. So if it goes down to 107, then you want to be able to do a 2x roll to a lower strike. Then you'd be back in 1,000, but you'll be back in 1,000 at $100 a call. And now you saved yourself, because you cashed out 138, don't forget, then you would have saved yourself $38,000, and you're back in the stock at a much lower strike. There's no downside to that strategy. But what's that strategy? Don't own a freaking stock you're worried about. That's the strategy. It's pretty simple. It's like, it's like when my kids are like, always when they were young, they were like, is this hot? And they'd be like dying to touch it. They're looking at me saying, is it hot? Am I going to burn myself? And I'm like, don't touch things you think are hot. It's like, why is it such a hard concept? It's like, if you think it's hot, just don't touch it. You don't need to find out for sure if it was hot or not. You say, that might be hot. I'm going to avoid it. It took a long time to get that through their skulls. It's amazing. And still to this day with spicy, they don't do that. Well, it's much funnier with spicy, because I don't mind. Petroleum report is out. Can you access the link above? The Upply Weekly? Hang on, let's see. It's this thing, isn't it? Why does it say highlights though? That's weird. No, there it is. They changed it. It's so wacky. All right, so we'll get to that in a minute. W6950. Oh God, wow. So glad I got out of that. Isn't that crazy? So now that this thing's out, though, you have to take this seriously. Now that the report is out and people are reading it, oil popped back to 69.50. So the question is, do I agree with them or not? And probably not, but let's read it and think about whether we agree with these guys. So hang on, I gotta make your box go away. You guys can't see this box, I don't think, but okay, that's a question box. All right, refinery inputs average 17.3 million barrels, blah, 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 46,000 more. Refineries, 93% don't care. Gasoline production decreased. Distillate fuel decreased. The production decreased of gasoline and fuel is very important. Oil imports average 7.8 million barrels, down by, are you freaking kidding me? Seriously? Is that true? Can we, oh wow, is the other one gone? It's gone, shit. Oh my God, seriously? Oh wait, it'll say that here. Oil imports 7.8 million. Net imports. I don't see that here. I don't know what they're talking about. I can't reconcile that. That seems like incredibly weird. Because they're saying U.S. crude imports average 7.8 million barrels a day, down by 1.3 million barrels per day from the previous week. That's just not believable. And you know what? There's a good point also. When you're reading a report, you've got to think. Okay? Just because some idiot wrote something doesn't mean it's true. We should certainly know that these days with the news cycles. Just because it's in print doesn't mean it's right. And that just doesn't sound right at all. It doesn't make any sense. It doesn't ring true at all. I don't know where they're getting that number. I don't know what they're talking about, but the chance of us having a 20% drop in imported barrels makes no sense. But over the past 4 weeks, crude oil imports averaged 8.3, that's not that much more, per day. Total gasoline imports, average blah, 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 distillate fuel imports, average whatever. All right, commercial crude inventories decreased by 6.1 million. At 4 million, the crude inventories are 3% below the average. Total motor gasoline decreased by 2.3 million barrels and 4% above the average. Motor gasoline inventories are 4% above the average. So oil 3% below and gasoline 4% above. What does that mean? They took these barrels of oil and they made gasoline with it. Oh no, wait, below average. And these are above, right. So they took 3% of the oil and they made gasoline, 4%. That's all. It's a wash, it's nothing. Finished gasoline blending components inventories, distillate fuel inventories are decreased by nothing and are about 13% below the 5-year average. That's interesting. Propane decreased and about 12% below the 5-year average. So they're not making a lot of distillates. That's the problem. Total product supplied over the 4-week period, 21 million. Okay, fine. So what you want to look for when you're looking at this is, are there any big discrepancies, big changes? No. Inputs about the same. Capacity utilization. Now, that's funny because they said up here, refineries operate at 93.8% of their capacity. This report, this narrative doesn't agree with what's on the paper right below it. It's so weird. That's very unusual. That's a really big discrepancy. There's a couple of big discrepancies here. I don't know what to say about that. Gasoline production, same as last year. Distillate production, same as last year, a little more. Oil in storage, down for the week. Oh wait, where's our other oil? Distillate fuels, flat. Motor gasoline up a little bit. Other oils actually flat. So we do have a net draw of, but what's your net draw of all products? 18s, there's a build. Wait. What? What is going on here? Okay, this is 7 less. This is 2 less. That's 9 less. That's flat. This one is 36, 37. This is 1 less. So that's 10. And this is flat. But this should be, oh, it is 10. Haha, 65, 50. See that? So it's actually, that's 65 and that's 55. So there was a net draw overall of all of our products of about 10 million barrels, 5.8 should 6, just about 10 million barrel draw total. So that's a good draw. That actually, that makes me not want to jump right back in and short oil. That's a good reason for it to come up. The overall stocks went down 10 million barrels. That's a good week for the bulls anyway. Otherwise, things are basically the same. So that's the same, that's the same. Look at what we're exporting. We're exporting 21 million barrels a week of oil. Not oil, product, finished product. 21 million barrels. Our total daily supply is 21 million barrels. We're shipping 1 in 7 days out of the country. So 15% of the US production of oil is not for the US. So when they start telling you how much demand there is, it's bullshit. If we weren't shipping it out of the country, it'd be piling up then you'd have a 10 million, instead of a 10 million draw, you'd have a 10 million bill. We're shipping all of our reserves out of the country. That's what we're doing. At an astounding rate of 21 million barrels per week. And all we've done in the course of a year is knock 140,000 barrels off. So in 52 weeks, we've knocked off 7 weeks worth of product from the thing. So again, there's very little demand. We are shipping out incredible amounts of oil, and the only way we can be doing that without this number dropping off incredibly is because the demand is slowing in the US. The actual internal US demand is slow. And here, where's the calculator? So if we're shipping out 21 million barrels, what? Number one. If we're shipping out 21 million barrels a week times 52 weeks, 1 billion barrels have been shipped out of the country. 1 billion. Last year, we had 2 billion barrels in storage of all product. We shipped 1 billion out of the country, but we still have 1.85 billion barrels left. Imagine if we weren't shipping all that out, and it used to be illegal to ship that out. They changed the law. That's why we're shipping all this crap out. That's why this is happening. If we weren't shipping that out, we would now have close to 3 billion barrels of oil sitting around. We have nowhere to put 3 billion barrels. We wouldn't have it because there's nowhere to put it, and they would have to encourage you to waste gas somehow. Otherwise, it would be flooding out of everything they got. They would have to shut down production in the US just to stop us from having too much gas. There'd be nowhere to put the stuff. So that's why this whole thing is such a sham. Distillate fuel, blah, 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 blah. Okay, product supply, and then there's nothing here. Meanwhile, though, last year, oil was 45 bucks, now it's 70. So 25 bucks, which is 30 something percent, 40%. No, wait, 25 bucks is more than 50%, sorry. 25 into 45 is a big number. 25 divided by 45, 55%. Oil's up 55% from last year. That's freaking insane. The demand is the same. It's actually less. Look, see product supply? They're supplying less product for 55% more money. Less product, 55% more money. We're using, where to go? We're using nothing. Week to week, not a big change. We're shipping it out of the country and we're subsidizing this oil that's being shipped out of the country at the pump. That's what's going on here. Pissed me off. Anyway, I was going to say that's a good reason to short it then. So after reading that, I'm like, okay, we can still be short. All right, I don't want to get short unless it's best. See, that's where I got out before. That's a shame. All right, well, anyway, I'm still, as I said, I do like the short of 69.50. I'm not really looking to just chase it around right now, though. All right, so what else is going on in the news? Let's take a look, see if there's any questions before I leave this part. Okay, nope, okay, good. So then we'll take a look at the news on Seeking Alpha. News. Ew, what's that? There you go. All right, Google Drive approaches 1 billion. I just use Google Drive. I upload that picture, that video for some of my friends. I didn't even know I had it, but I apparently do. Freeport cutting Indonesian production guidance. Wow, that might be, oh, they're only down 2.5%. You know, it's stuff like that happens. You have disruptions in various countries. Oh, there's a very interesting article the other day about South Africa's gold mines are depleting. They're going to actually have to find something else to do. And diamonds are in big trouble. So South Africa's in big trouble. The gold mines are being depleted, and diamond mines, which are a big thing in South Africa, drives their economy. People, you can make diamonds now. And nobody can tell. It's the exact same thing. In fact, there's laws. You have to mark them. If you make them, you have to mark them as a manufactured diamond because otherwise no one can freaking tell. There's nothing about it that makes it look different than a diamond. In fact, it's a perfect diamond that can be made by machines now for 1/10 the price of diamonds. And nobody has to go into deep mines, and no one has to get black lung disease, and you don't need slave labor. just drop some carbon in a machine, and the machine spits out diamonds. So that industry is dead. Those guys are in big trouble. Coca-Cola earnings, and kids don't even wear those things. Kids don't even go for that kind of stuff anymore. So much less than we did. Coca-Cola sees less ham to empty. Really? Mixed trends, give us concerned, slow down margins. Because again, it's discretionary. Anybody selling to discretionary consumers on the lower end of the scale is in trouble. And that's a trend you want to watch for in earnings. Okay, if people who serve the bottom 80% are going to have a lot of trouble because their customers are going broke. RVs, wow, poor RVs. Although I was wondering how the hell they were staying alive anyway. I think people are using them as homes. But other than that, I don't see, when the hell you see an RV running around? How many people really riding those things? So Fox, blah, 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 we can care about them. We'll care about that when Disney starts coming out with more superhero movies, because Fox owns some parts of Marvel that Disney doesn't. So that's one of the reasons they bought Fox, is to consolidate the entire Marvel database. What happened? Montana skeptic reported his work colleague received a call from Tesla from Musk complaining that his short-focused articles and threatening legal action. Oh, I see. Oh, well, we'll see what happens with Musk next week, but oh my God. Those guys are messed up. I mean, they went to the suppliers asking for apparently refunds, but now they're just claiming it wasn't refunds, but it's going for, but they're trying to renegotiate with the suppliers to stop the bleeding on the cash. Their cash burn is going to be astounding. And that's why with earnings coming up, they're probably hitting the $2 billion loss mark for this quarter at least. And $2 billion for the quarter in losses. And they don't have that kind of money. They can't burn anymore. They're going to have to raise money after reporting a crappy quarter. So they went to their suppliers, and the story seems to be the real story, not the story Google's that Tesla's thing. The story seems to be that they went to their suppliers and asked them to retroactively refund them for stuff they already bought. Not giving it back, just to say in other words, like, we gave you $3 billion last quarter. Could you please give us back $600 million? Okay, after we bought the stuff. And no, we're not returning it. We just want you to give it to us for less money. And by way of giving them money. Why? They want that because if the suppliers give them the money, then they report a better quarter, right? They didn't use the money to buy the stuff. They got a refund on parts, and that's going to show up as a profit or less of a loss or whatever. So obviously, apparently every single supplier laughed him out of the office, and word spread around, and they couldn't contain the story. So now Tesla has backtracked and said, no, we were only negotiating forward, whatever. And also, by the way, they're going to these suppliers and saying, look, if we die, then where's your business? And meanwhile, the suppliers are like, but you're not paying us for the stuff we have now. At a certain point, you just say, if you're dying, die already. Don't keep buying crap from us. They're slow paying all the suppliers. That's been going on forever. It's a total mess. So there's all kinds of crap. They're acting like a company's going to go bankrupt. They're everything they do is consistent with a company that's not going to be around long. So we'll see what actually happens. iRobot, can't believe we got out of that. iRobot was at stock of the century at one point at the beginning of the century, 10 years ago. iRobot was at stock of the century, or 15 years ago. No, it wasn't. It had to be 2007, 8. We picked it. And they've done very well. But they split the company and they sold off their military division, which was one of the reasons I liked them. So I'm sad about that, and that's why we don't play them anymore. But they're still doing fantastic. Owens Corning missed. Wow. Meanwhile, I don't see any reason the market would have moved in particular right now. Beazer Homes is slumpy. The home builders, well, we just said that, right? We talked about that this morning in the Post, that mortgage applications are down, home sales are down, prices are down, inventory's up. This is all bad. Bad, okay? We don't have any of these things, fortunately, but we will get some if they keep going down. So all bad. And it's a terrible, terrible sign for the economy that's being completely ignored by the markets, and I don't understand it. I really don't. I don't know what's going on here. But of course, I said this in 2007 and 2008, and we didn't do webinars then. But I mean, I would say it in the chat. If you go back to those chats, I'm sitting there saying this. I said the only way you can trade this market is to smash your head out in with a brick before you start trading, because you cannot use your brain to trade the market. That was why you say in 2007, 2008. I said you cannot possibly think and trade, otherwise you wouldn't be trading. And that's where we are now. This stuff is crap. I don't like the market at all. We just doubled down on our SQQQs in the short-term portfolio because we liked our long-term portfolio plays too much to cut them. But that being the case, then we needed to add a lot more protection in the short-term portfolio in case things turn sour faster than we can react. UK retail, another heat wave. The heat wave in Japan, heat wave in the UK, the Southwest in the where the Dust Bowl was. That was one of the causes of the Great Depression. Is having the conditions are as bad as they were during the Dust Bowl, where everything just dried up. There were droughts, heat, and the crops turned to ashes, and the ground became so dry and broken up that it started blowing around in the wind. That's what the Dust Bowl was. In other words, all the soil had nothing holding it down anymore, and it wasn't wet. So it would just get picked up by the winds and scattered around. There were giant clouds of dust everywhere, and that's why they call it the Dust Bowl. But what does it really mean? It means the ground is dead. You can't plant crops. The farmers go broke. That's why Trump's running around handing out cash right now. And is it all his fault? Yeah. I mean, not that he probably could have stopped it, but it's a global warming issue. And they're doing nothing about it, nothing at all. And maybe he couldn't have stopped the warming, but you could have gotten the Army and Corps of Engineers by recognizing you have global warming and recognizing you've got a problem. You send the Army Corps of Engineer out there and you start putting irrigation channels through the farms, and you make a plan for what to do when they have no moisture. None of that happened because they pretend there's no such thing as global warming. And they screw everybody. And once you ruin that land, it takes years and years to come back. And you think Trump's going to have $12 billion for them every year? No. He's only got $12 billion now because of the tariffs. Tariffs of $50 billion worth of tariffs at 25% generates $12 billion in taxes. That's where he got $12 billion from to hand out to the farmers. Can't do that every year. But you can, but it's going to be insane. CSX has an oil spill settlement, so what? How much? Million. Who cares? Holy crap. MGX. German business confidence lower. These guys keep getting less and less confident. Business expectations 98 below 100 now. Wow, that's ugly. So there's nothing here in the news that should be moving the market. This is all our own crap. Broadcasters rise. Broadcasters gaining appeals courts declines to overtell the UHF discount. Blah, 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 blah. Okay, not that important. Morgan Stanley. Oh, Morgan Stanley is this happens all the time before iPhone earnings. Is people come out and start making rumors that there's something wrong with Apple, something wrong with iPhone, something wrong with shipments. Because Apple won't comment. And they know Apple won't comment, which means you can make any kind of bullshit up, and it's just going to sit there and cause people to run out of the stock. And that way, the big boys can come in and buy some ahead of earnings at a cheaper price. Viacom, Singapore, E-Trade. There's nothing here. Nothing's going on. So there's no reason for the stocks to be up as much as they are. There's no reason for anything to be moving. There's nothing happening in oil, more importantly, to make it work. There's no reason oil should have risen like that. Except other than, of course, the headline build in the inventory report, which we know is not that significant. So more to the point, though, I want to be shorting here. So do we want to short the NASDAQ? Who's got earnings? Okay, so now let's have a premise. Do we want to short the NASDAQ? We're done with this RB, so let's take a look at some other indexes. Got the S&P, we got the NASDAQ, so we need the Dow. Okay, someone let me know if oil gets back to 69.50 so we can short that. Oh, you know what? RTY, right? Okay. See, they look like they're not going to fall below that. That's tough. So tricky short. I don't know if I want to short it. How about said YG, right? We were looking at. Ooh, that came up too much. I want to short. I'm not going to chase gold. I'm sure silver's up too. Can't do that. Unfortunately, now there's a good trade from last week, but they were already taken off, so I'm going to go chasing them for now. NG, natural gas, also big recovery. Holy crap. Nothing fun. How about coffee, KC? That's good. All right, coffee's not bad. So now let's see. I like KC N9, and we had a. Wait, what just happened? KC, is it N9 next July, right? N9, it should be next July. It's not great because it could be lower, but oh, I still have too long. All right, sorry. So I still have too long from last time. That's from last week. We had 121.25, so they're up $1,000 from last week. I'm good with those. I want to stick with that. So nothing to trade there. And we'll go back then. So in that case, we're going to go back to the ES on the S&P. There's nothing fun to trade really, unfortunately. And I'm not thrilled with these plays, but. So who would be the most, see, here's the thing, who's the most likely to fall if we're going to fall? Who's going to do it for us? And for that, we're going to go to Earnings Whisper. Earnings Whisper. Let's go on Twitter, that's a good idea. Because they'll have their charts right here. All right, so Earnings Whisper, most anticipated releases for Thursday. Who's out? McDonald's. Celgene, ooh, Celgene's a fun long. Okay, wait a minute, that's interesting. MasterCard's a fun short. Now that's a Dow component, so there's a good reason to short the Dow, because if they miss, that'll take the Dow down. Wow, look at the wrestling, holy crap. They cannot possibly hit their number. Can they justify that? That's a toughie. Southwest is way down. I don't know how to make that go away, the brown part. AMD is really high. Is that AMD? No, it's not. Something else. American Airlines took a hit. Spot, Jesus. Oh, that's Spotify. Holy crap, look at them go. Well, Celgene is very interesting for long. Comcast is probably oversold, but they've got their whole merger thing going on. Okay. Oops. And what's this? This is today? All right. I'm opening a new tab. Let's see if it's better. Oh, yeah, there you go. So we got Las Vegas Sands. We got Ford, we know we kind of like down here. Facebook, wild card. But, you know, again, Facebook being super high in the channel, that means it's probably not going to go up that much. But here's Visa too, way up. There's a lot of guys who get disappointed here. Qualcomm we like, but you know, we'll see what happens to them. Gilead we like down here. PayPal super high. So a lot of credit card people are going to report, and my premise is that the credit card people aren't going to be that great. They're going to have increasing delinquencies, and they're going to probably have a slowdown in spending because the bottom line consumers are, well, to some extent they may be stretching what they've got, but to another extent I think they're just going to be slowing down the spending a little bit. Retail sales reports that were good, so it might not be showing up right now. But anyway, so again, given the choices, what's the best thing to short? I think I'm going to go for the Dow. So let's go for the Dow. Actually, you know what? I'm going to do two Dow. So let's do Dow one, and we'll do another one. Really want 50, but all right, let's just do one unless we get our marks. Here I want 85. So got to turn on the automatics. All right, so here I really want 85, and here I want 50. So whoever goes up first, I'll probably add more to. But let's take 1 and 1 and see how those play out. All right, so that's our official shorts: 25, 241, and 74, 83, 25. But again, I definitely want to add another one and average about $1 higher, 1 point higher on both of them. And we'll see how that plays out tomorrow with the earnings. But I think there's enough people that can disappoint to make us happy. So we will see what happens. Where is that chart? Wasn't this one, it was the other one that seemed to be, it was, well, MasterCard I like for the short, but let's not be negative. So now, see again, since I'm shorting the futures, I should look for a long that I want to play, right? And a long I want to play, I think Celgene looks interesting. Why is Celgene down so much? Now we go to Yahoo, and we look at Celgene, C-E-L-G. And we say, what? What? $85, that's going back a year. Oh, that's why. It's so weird. But the chart's like not worth there. That's better. I'm like trying to figure out what the hell is going on with that thing. How could it possibly be there? Too many things are shiftable. Anyway, so that seems like a good price. What have they done wrong? You know, this says their PE is 24. That seems like a lot. So I want to see if that's real or not. $63 billion. They made $3 billion last year. That PE sounds like 20 to me. Now here's the problem though. What are they paying taxes? Well, no, they paid a hefty tax bill last year. They didn't pay less in taxes. All right, that's not bad. How's their quarterlies holding up? Quarterly, that's not good. Hopefully that was a one-time expense, but it was last year. Wow, so last year, even with that, they still did good. Look at this income before tax $1 billion, income tax expense 184. So 18% tax they pay. So 846 for the first quarter. That means they're certainly on track for another $3 billion a year. So the P is about 20. Analysts say that they're going to make $8 a share, which would be a P of 10. So one of them's wrong. But even so, the point is 744, 850, so that's 15% growth. Next year, they're looking at 950, another 15% growth. So they're growing nicely. They got a P of no more than 20, possibly less. Sounds good to me. All right, so I like Celgene. So we want to say they seem to be underpriced into earnings. So that being the case, now I'm going to look up Celgene. CELG. And if we want to do an earnings play, why don't we do January? Because we can always back January out into, if they get a good reaction, the January will pay off pretty quickly. But if they don't get a good reaction, then you can always adjust and roll. Now, since Celgene is a permanently good stock, something you'd always want to own, we could sell something further out in time. So let's sell 5 would be $50,000 basically, or $40,000 here. So let's sell 5 of the $90 puts. No, that's too high. Sorry. No, let's sell 5 of the $85 puts for $9 or $9.20, whatever it is. That's $4,500. And then we'll pick up, and again, we're not going to overdo it. So we're going to pick up, we're selling 5 here, and we're just going to buy 5 of the, we're going to buy for the pop. So we're going to buy aggressive, we're going to buy assuming they aggressively go up. So instead of putting a lot of money into it, we can get the 90s for $6 and sell the 100s for $270. So that's going to be $330. That's $3,300. So we're collecting, I forgot now, we're collecting we're collecting $4,500 here, selling the 85 puts, 5. And here, the 90-100 spread, if we just do if we do 10 of them, it's only $3,700. So we're netting still about $800, $1,000. So we're netting $1,000, which means that with 5, we're going to come in at like $83 is going to be our net entry on the short put side. There's nothing wrong with that. Again, it's not a big deal, right? So $83 there, but we've got 10 of these $10 spreads, which were the 90-100 spreads. 90's out of the money. But we're doing that because we want to have a cheap spread. Now, what's going to happen if Celgene pops? We're on the way to 100. We're going to make $10,000 at 100 off that $1,000 credit. So we could have potentially be up $11,000 on the $1,000 credit, and we're going to get $10,000 in our pocket fast. If Celgene is flat, then we still can roll the long 90 calls to something longer in 2020 and then wait for the short calls to expire and then sell more calls along the way. Or if Celgene goes down, we're still going to be able to do the roll, and it'll just be cheaper to move to the 2020s. It'll be a less expensive roll, and then but if it goes down, then we would immediately move to a spread like the 75-100 spread, which is 20 minus 8 is 12. All right, so we would take the remaining cash here, which might be $5 or $4. We'd spend $8 more, and we'd be into this spread, the 75-100 spread for 12. And that would become a longer term position against which we would sell short-term calls. So it's like chess. It's like I'm looking 3 moves ahead, and all 3 moves are fine. So I'm going to make my move, right? There's no reason not to make the move based on that. I'm looking 3 moves down the line, and any of those outcomes I don't mind. And meanwhile, we can make a very quick $10,000 on this spread. So again, why not? May as well do that. That's a good earnings play. They seem to be overly sold off, and if they have any kind of decent earnings report, they'll probably come back up. Now, if everybody's selling off and everybody has crappy reports tomorrow, it won't matter because we have a couple of short positions that might pay off. Oh, and look, we're up already. How nice. Okay. Things are going well. All right, so we're going to wrap up the webinar. Thank you, everybody, for coming. I'm going to just quickly check questions. How's oil? Didn't go up. Oh, well, too bad. Let's see. Quick questions only. Any adjustments on ABX or wait for results? Definitely waiting for results, and after that, we'll see if we want to adjust, but we've already gotten pretty heavy on it. ALB, we bought back short calls. What do you anticipate for earnings? Do you want to buy those back? No, I think I don't think we have an anticipation. I think we expect them to do a little bit better, and then we'll see what happens. We'll see what the results are, and then we'll do it. You know, look, it's nothing wrong with waiting for information before you do something. You know, I'm not worried about it as a position. I don't remember what our position is right now, but you know, I'm not worried about them. I just think eventually they'll turn around. If they don't turn around now, we'll have to wait, and then we'll decide whether we want to put more money into it while we're waiting. Any adjustments ABX, we're waiting. I said, 3 says, I live in the boonies, Phil. If you grew up poor and grew successful in a prudent way, what? I didn't grow up poor. I grew up, well, all right. Well, honestly, my parents went bankrupt in 1972. Yeah, I think that was right. So, you know, when there was a recession, my parents went bankrupt. My father had 3 different jobs. One of his jobs he got just so he could have a car. And he had this terrible station wagon with a loudspeaker on it, and he drove around. I don't even remember what it was, but I remember he would drive around saying something to the loudspeaker. Like in the Blues Brothers, you know, where they go around town like, the Blues Brothers will be playing. So that was one of his jobs that he did just so he can have them, because he was a station wagon. So he did it just so he'd have a car for the family. My mom worked 2 or 3 jobs at a time also. So in that way, we definitely dug our way out. We weren't poor from the beginning, or we weren't rich. We were average, but then my parents became pretty successful. So when I went to college, I paid and we were just talking about this in my family. My older stepbrothers paid for their own college. I paid for my own college. I worked my ass off to pay for my own school. But my parents got kind of rich. Like my stepfather was a top-notch polymer chemist. He invented some cool stuff. One of the things he invented was a way to get better inks on shrink wrap. Like at the time, shrink wrap was popular, the stuff that they put around like a big plastic bottle, and it used to be made out of foam, and it was very hard to print anything on. My stepfather was the guy who invented like better inks for that to make more vibrant colors. So he had a company, and that company got successful when he sold the company. So they did very well, you know, after he worked his ass off. And the whole time he was doing all this stuff. You know, he was always a chemist, but he had other jobs because the chemist wasn't paying well. He was always stuck with that though. So anyway, so that's my poverty stories. We had nothing for a few years. They clawed back to be reasonable, and we got into this place. But then finally, boom, something hit. By the time I was in college, which is 6 years later after that. Wait, 81 was college. So yeah, 10 years later. So by 10 years later, my parents had become from bankrupt to wealthy and successful. But I'm already in school at the time, paying for my own college. My little brother, though, got a full boat, everything paid for, including got a car and all this other crap. And me and my other brother's like, what the hell? You know, we were paying off debts for years for college, and we paid for our own cars. And my little brother got everything just handed to him. It was amazing. Like we never really, it's funny because none of us resented it really at the time. We were all like, now we're sitting here going, wait a minute, what the hell? So anyway, so that's my success story. And of course, because my parents had no money, when I was 10 years old, I had to paper route it. My parents were like, if you want, hey, you want some money? Go work. So when I was 10, I had a paper route. And that was my start of my working career, and I worked my ass off from that point forward. So RD is a must buy as you get close to retirement. Not sure why, it's just the way it is. All right, well, that's good, but we're not going to get into that now. Also want to confirm that in the long-term portfolio, your short CM September somewhat puts, I did not see it in the review of the spreadsheet. Huh, that's weird. All right, well, remind me in chat, okay? Don't, that's Brendan said that. Remind me in the chat room because I'm not sure why that wouldn't be there. I do remember we had CM, and I'm sure we sold some puts. So I'm not, maybe it fell off, or maybe they canceled out. I don't know. Oh, that would be for September. They didn't go, no, they're not out yet. I don't know what's going on. Celgene has a weak pipeline, says JC. Okay, well that's worrying, but we're taking a small position, and I like the company overall. Pipelines come and go, so we'll see. But yeah, no, I mean, again, it's why I'm being cautious about it, because you never know with these things. Putting that Celgene earnings play for the short-term portfolio, yes, I am. That is what we're going to do with it. Okay, it's good to have an aggressive earnings play that we don't mind moving to the long-term portfolio if it goes against us. But I think that the weak pipeline stuff for Celgene is already baked into that big drop they've had. But we'll see. Anyway, thanks everybody for coming, and we will do it again next week. Okay, and hopefully these short plays work out. But doing good so far. We'll see what happens. All right, take care.